Welcome back. Let's bring in Philip Petursson now. Philip is Chief Investment Strategist at IG Wealth Management. Philip, thanks a lot for joining us as always. Why don't we start, Philip, with the Canadian currency, as we've noted, and as the financial media tends to note, the dollar has touched a new low against the U.S. dollar. It's a 2022 low of about 75.2 cents. You have to go back to November of 2020 before you find a loonie this week versus the greenback. But as we've noted, and as you well know, this is more a story of U.S. dollar strength than it is against as fundamental Canadian dollar weakness. What's your take on the loonie right now?
Well, first, thanks for having me on, Paul, but you're exactly right. This is all a story of the U.S. dollar strength. It runs counter to where the Canadian dollar should be based on oil prices and based on the interest rate differential between Canada and the United States. The loonie should be in our view, that 81 to 83 cent range, but it's being held down by this very unusual strength in the U.S. dollar. And I say unusual because in this type of economic environment where growth is slowing down and inflation is accelerating, historically, the U.S. dollar has weakened. It's run counter to that trend. It's continued to push up through this year, keeping the loonie lower, keeping oil prices, we can argue, somewhat lower, gold lower, other commodities lower, and it is one of those factors in the market today that's rather befuddling.
I can see on my screen here the Canadian dollar versus the yen, versus the euro, versus the pound sterling at multi-year highs. Why is the Canadian currency doing so well in those currency markets?
Well, there I would say that what you do see is that relationship between the Canadian dollar and oil, with oil prices being higher than where we were a year ago, 2 years ago. That has provided a boost to the Canadian dollar relative to other crosses, except that one predominant one being that U.S. dollar.
What's your take on equity markets? They took it on the chin on that inflation reading in the U.S. earlier this week in a big way. They're taking it on the chin today because a very influential company, FedEx, has delivered some bad news.
Yes, and this is a theme that I think we can see going forward, not in terms of just the volatility in the marketplace, but the differences across geographies. And let's go back to Monday, because what we saw was a pretty good sell-off in the U.S. equity market, whether it's be the S&P 500 or the NASDAQ, and we didn't see similar downside pressure in Canada. It was much softer. In Europe, it was much softer. And that's been kind of the theme over the course of the week. I relate this all to valuation. Eventually, valuation matters. And what we're seeing right now is the U.S. equity market that is rather fully valued, rather richly valued to interest rates and inflation, versus Canada that is trading at very attractive levels, Europe trading at very attractive levels, emerging markets at attractive levels. This is the difference, because you potentially have more downside risk with that higher valued U.S. equity market. Like today, you're seeing more downside in U.S. equities than you're seeing elsewhere around the world.
So I think I hear you saying that the U.S. stock market has further to go on the downside. As you were speaking, we just showed our viewers a view of the S&P 500 index, where it's getting closer now to touching that June bottom, which from which a rally began earlier this summer.
Yeah, it's very hard to predict whether we have more downside, but I would say there's more downside risk versus the valuation. When you look at, again, we have to compare it. All markets are relative in comparison. So Canada looks like the equity market has priced in the downside risk of a potential recession in 2023. That doesn't seem to be the case in the United States, where the inflation environment is actually quite the same, Canada, the U.S., yet our market is substantially cheaper.
And what is your view then of the Canadian market, where it may go from here? It is also the TSX Composite well off its highs.
It is, but again, it's had a better run this year than the U.S. has had less downside. And when we think going forward over the course of the next year, the economic risks are, I would argue, similar in Canada to the United States. There is that potential for a recession in the first half of 2023. But when we look at the drivers of the Canadian stock market, it is much less economically sensitive to the Canadian economy and a little bit more globally sensitive. But with oil prices at these levels, and I think it can trend higher because of very, very tight oil supply versus demand, that bodes well for the TSX next year. I think valuation bodes well for the TSX. And here's where we can see the TSX perhaps outperforming the S&P 500 as it has this year, but continuing on through next year.
The most influential central bank in the world, the Fed, will make a policy announcement on Wednesday of next week. A 75 basis point rate increase seems to be almost universally expected. What about the Fed's forward-looking view? I believe we'll get the so-called dot plots on Wednesday, which will give us a snapshot of the views of Fed governors on where rates are going. What would you expect to see?
Well, the market is expecting 4.25 being the terminal rate, and I think that's fair. I think we can get to that sometime in the first half of 2023. And I think what's important is that I doubt Powell is going to back off from his posturing from Jackson Hole to what we've heard from some of the other Fed governors recently. So I think they remain hawkish on inflation. They want to see inflation come down significantly, and we had that bump in the road on inflation. The disinflationary pressures this week as core inflation showed stronger than headline. That, I think, it caught everyone's attention. Certainly, I think will catch the Fed's attention. I think the narrative from here will be the job's not done yet. We're going to continue on. But watch as you pointed out, Paul, watch those dot plots. I do think 4.25 is going to be that terminal rate.
Very quickly, what do you think the Bank of Canada's terminal rate will be?
There, I think it's going to be lower. I think we're closer to 3.75 or 3.75%. Reason being is we're starting to see some weakness in the labor market. The last 3 job prints in Canada were all negative. Over the last 6 months, we created a net 15,000 jobs. So that's well below where perhaps we should be. So I think the Bank of Canada is going to be a little bit more sensitive to the Canadian economy and pause perhaps a little bit sooner than the Fed.